to the recognition of revenue. You can only recognize revenue when performance obligation has been satisfied. What do we mean by performance obligation has been satisfied? When control associated with the goods has been passed on to the customer. You can't say that you are selling your car and I've paid for the car. You are still using the car. You are still insuring the car. You are still carrying out maintenance on the car. And you still have control over the car. No, you can't say that you have sold the car and you are going to recognize a sale for the car. No, because the car is still with you. You can only recognize the sale of the car if you have what? Transfer ownership of the car to me, or if I'm now in possession of the car, if I'm now in control of the car. So the fifth step is a crucial step for the recognition revenue. The identification of contracts, allocation of prices, all those things here are just something for you to recognize the amounts. It's just the amounts. If you have delivered the goods to the person with no return policy, it means that goods sold are not returnable. What will be the price that you are going to be recognizing? That is the other steps, that allocation of price, determination of transaction price, those are the ones. But if you want to recognize revenue, it is the fifth step, which is recognize revenue when performance obligation has been satisfied. We are going to look at how performance obligation can be satisfied. Okay, you can enter into a contract with someone to construct a story building for the person. You see that a story building cannot be completed at once. No, it will be completed in stages. Okay, if you complete the ground floor, the person can move on, the person can move in with the family. See, some people, if you are constructing, they will say, okay, I don't want to pay rent again. So just finish this place. We move on to this place, or we move into this place and you continue with the other place. So sometimes you can see that the owner of the building will be at the down and the people will be working at the top. That particular one, as soon as you complete part of the work, control or ownership will be transferred to the person. So you see that you have completed the ground floor. The person is now moving in. It means that you have transferred ownership to the person. So what is the revenue that you can recognize to the completion of the first one? What is the cost that you incurred? Then you can recognize revenue for the part of the work that has completed. You can recognize revenue for that side, because if you finish one part, the person can move in. That is one side. So you can recognize revenue when a performance obligation is satisfied over time. So it means that if you finish some part of it, you recognize revenue relating to the part that you have finished. Performance obligation can also be satisfied at a point in time. At a point in time, what is the meaning? At a point in time means that you can only recognize revenue when delivery has been done to the person, when the person has received the goods finally. So you have to be very careful with how the examiner will be asking you questions, because this is the revenue as a standard. It is based on the recognition of revenue, and which is the performance being satisfied over time and performance satisfied at a point in time. So if you enter into a contract to construct 5-story building for the person, and the question says that performance is satisfied at a point in time, you can only recognize revenue when you have completed all the 5-story building, and you have now hand over the building to the person. That is the only time that you can recognize revenue. You only recognize revenue after completion of the work. When delivery control has been passed to the person, that is, performance obligation is satisfied at a point in time. You only recognize revenue when control, possession, risks, everything associated with the assets has been passed on to the third party. But a point over time means that the performance obligation will be performed at a point over time. So you have entered into a contract to supply goods to the person over 2 years. So the first 6 months, what's the quantity of the goods that you have transferred to the person? Determine the revenue that you should recognize on the goods that you have delivered. That is a performance obligation satisfied at a point over time. So you have to pay very much attention to this one. What are some of the issues that will come if the question will say that performance is satisfied at a point in time. Sometimes the person can make an initial deposit. Okay, so you are saying that the contract is I'm going to construct maybe, or I'm going to construct chamber and hall, like I'm the contractor, and you are now telling me that I should build chamber and hall for you. And my policy is that I will only recognize revenue at a point in time. Meaning is that I have to finish everything, do everything that I'm supposed to do. Then I'll hand over the key and then the house to you. That is the only time that I can recognize revenue. So what will happen is that I can ask you to do some deposits. So the total cost is 100 million. So I can ask you to do some deposit of 20 million. I can only recognize revenue when I have hand over the house to you. Okay, so in 2 years' time, if I'm done with everything, I've handed over the building to you, then I'll recognize a revenue of what? 100 million. But now you have made a deposit of what? 20 million. You're supposed not to give me money. You have to give me the money after I've given the house to you. The key and everything to the house, I've given it to you. Ownership has been transferred to you. But you have made a deposit of 20 million. This particular deposit will not be recognized as a revenue because I haven't performed the performance obligation. It hasn't been satisfied. So I have to recognize this as a loan. And I will assume that I'm using this loan to generate revenue. So I'll be using my borrowing rate to find the loan, to find the interest on this particular loan at the end of every year. Then after 2 years, I'll now receive the remaining 80 million. Then I'll recognize a revenue of 100 million. Okay, come here. We are talking about what? Chamber and hall, which is going to take 2 years to complete. This can be qualified as what? A qualifying asset. We can say that the chamber and hall is a qualifying asset. The chamber and hall is a qualifying asset because it's going to take a substantial period to get ready for use. So what will happen is that you have to use the principle of what? 23, IS 23. Why? Because you are here to what? Transfer the building to what? To the owner. So the building will be seen as the company constructing the building themselves, and they are now what? Contracting a loan of 20 million to finance the construction. So initially you are going to say that the cost spent on the building is this. And every year, the interest that you'll be charging on a loan will be added to what? To the amount that you have borrowed, because this is a qualifying asset that you are taking a loan to what? To construct it. So the deposit that you are taking from the person will be seen as a loan that is being used to what? Construct a qualifying asset. So you have to use the principle of what? 23, borrowing cost, IS 23. So you will see a question that they will say the policy of the company is to recognize revenue at a point in time. At a point in time means that you have to what? Transfer, or you have to deliver the goods to the person before you can recognize revenue. So if the person made an advance payment before the delivery, that particular advance payment will be seen as a loan given to the company. Then the company will now calculate interest on it. That is at a point in time. What about at a point over time? At a point over time normally works with what? The construction companies, where you are going to enter into a contract to construct maybe 3-story building. If I finish the ground floor, the owner of the house can decide to move in with the family. It means that that particular portion has been transferred to them. So I recognize revenue relating to what? The completion and the cost. So I will just recognize the revenue on the part of the contract that I have completed. And I will just recognize my revenue on that one. How do we recognize the revenue? We use 2 methods for recognizing revenue based on what? The point over time. And these methods are something that we are going to be looking at right now. The first method is, okay, the first method is what we call the input method. Okay, and the second one is what we call the output method. Okay, the input method, what do we use? We use cost to determine our revenue, and this one we use our output. The output over here, we use revenue. So they'll always give you the work certified. So they'll give you the work certified. We use the work certified over here. Okay, assuming we have entered into a contract to construct maybe a bridge for 2 years, and the total contract price is, so the total contract price is 200 million, and the total cost that we are expecting to spend on this particular contract is 150 million. What would be the overall profit from the contract?
50 million.
Okay, 50 million. Okay. Okay, assuming the first year we have incurred a cost of, assuming the first year we have incurred a cost of 80 million. Assuming the first year we have incurred a cost of what? 80 million. Okay, this cost of 80 million, what will be the portion of profit that we are going to be recognizing on this one? You have to know that if you incur 150 million cost, that is why you'll be having a revenue, you'll be having a profit of 50 million. Am I correct? If you incur all the cost, then it means that you are going to what? If you incur all the cost, it means that you have completed the work, and you are going to be having the 50 million as the profit. So 150 is equal to the 50 million. If you incur 150, it means that you have finished the work. Since you have finished the work, it means that you will be recognizing all the revenue. So 150 is equal to what? 50. 80 will now be equal to what? You don't know. All right. So what do? We have to look for our 50, and we can say that this will be 50 times 80 divided by what? 150. Is that correct?
Yes.
Okay. Okay. So our profit on that particular one, we can say that is calculated as the 80 over 150 times the 50. Let's now come here. This is the cost incurred to date. Cost incurred to date is the 80, and the total cost of the contract. The total cost is the 150 times the overall profit, or the actual profit, which is the overall profit from the contract. And this is what we call the input method. So the input method, if you want to find the profit that you are going to be getting, you just use the cost incurred to date. You find the proportion of the total cost, then you just apply it on the what? On the profit. That's how we find the profit. Sometimes the question can ask you to find the revenue. Okay, if you want to find the revenue, you use the same thing. It will be the cost incurred to date, the cost incurred to date over the total cost times the what? The contract price, which is the total contract price. So if you incurred 150, it means that the total revenue will be 200. Now you have incurred 80. What will be the total revenue? So you find the X. This is how you find it. And the cost of sales. So you recognize the revenue as part of the revenue, then you recognize cost of sales. Okay. So if you are using the input method, our revenue is calculated as the cost incurred to date over the total cost of the contract times the what? The contract price. That will give you the revenue. Then the cost of sales will just be the cost that you have incurred up to date. Then you recognize the two in your revenue and also the cost of sales. Sometimes they can ask you to find the profit. Let's find profit on the 80. What will be the profit on the 80?
26.6.
26.67. Okay, so 80 over 150 times what? 26 times 50. Okay, 26.7, isn't it?
Yes.
Okay. The question now is, if you want to build the person, how much would the person go? If you want to build the customer, how much are you going to be billing the customer? You have incurred a cost of 80 and a profit. You have to recognize a profit of 26.7. what will be the price that you, what will be the billing price that you'll be giving to the customer?
That's 106.
Okay, you'll be giving the customer 106, and that is the selling price of the contract that you have completed. You have incurred a cost of 80, and your profit is what, 26.7. This is the amount that the customer will be paying you. But it can happen that the customer has paid only 80. What will be the difference?
26.
26.7. So the customer is owing you this amount, which we call the contract asset. So sometimes you'll be seeing something like a contract asset. The contract asset is what is the amount that you'll be billing the customer? What is the selling price of the contract that you have completed? That will always be the cost to date plus the profit element that you should recognize on the completion. That is the amount that the customer will be paying you. Then the customer will pay you a certain amount of money. So you just subtract the amount that the customer has paid. The difference will be an asset, but we call it a contract asset. So the question can ask you to compute the contract assets. How do we go about a contract asset? We can also have contract liability, where the customer will be paying more than the amount that they have to pay. So let's look at the contract asset first. Contract assets. So the contract asset will be cost to date, cost incurred to date, okay, plus the profits on the completion. Then you subtract the cash received. Okay, so the difference will give you the contract asset. You can also have contract liability too. What you have to know is that when there is a loss, we don't make provision for loss. When there is a loss, you recognize the loss to profit or loss at once. So maybe there will be a loss on the contract. If there is a loss, let's assume that the cost incurred is 80, and you have incurred a loss of what? 10. It means that the amount that the customer will be paying you will be 70. So if the customer pays 50, then you'll be having a contract asset of what? Of 20. So this is how you find a contract asset. We have looked at the input method. The input method, we use the cost. Input means what we are putting in. So we use the cost. We are going to be using the cost. Okay. But we also have what we call the output method. The output method will be based on the what? On the revenue. So mostly the question will ask you to find the percentage of completion. What is the percentage of completion? The percentage of completion is calculated as the cost incurred to date over total cost times 100. That is the percentage of completion. So the question can ask you to find the percentage of completion. Okay, percentage of completion. The only time that you can complete the work is if you incur what? 150 million. So if you incur a cost of 150 million, it means that you have completed the work, because that is the total cost that you have to spend on the work. So if you spend all the 150, it means that you have completed the work. But if you have only spent 70 out of that, it means that you have completed 70 out of the 150. So it will be 70 over 150 times 100. So if you are using the input method, percentage of completion is the cost incurred to date over the total cost times what? 100. Okay, so that is for the input method. Let's look at the output method. The output method, there's nothing different. Calculation of profit and those ones you say. But what we do is that the percentage of completion, what we do is we don't use the cost again. We use the work certified. So they will give you the work certified by a professional person. The work certified by a professional person divided by the contract price, which is the revenue, total revenue, then you multiply by 100. So for this one, we use the output. What is a professional has certified your work. So what is the value of the work certified? You divide it by the contract price, then that is it. It means that out of the revenue, that is the portion that you'll be recognizing. So the revenue was 200 million, and the work certified is what? 80 million. So it means that out of the 200 million, you'll be receiving a revenue of what? 80 million now. The question is, what is the percentage of the work that is completed? It will be the 80 out of 200 times 100. The calculation of the contract price or the liability is still the same. It's still the same. And this will always be for corporate reporting side. So let's pick some 2 questions on this particular one. Then
Senior Linus.
Yes, Senior.
Senior, please let me take you back small about the formula you just gave on output method. Please, I didn't get it.
Okay, the output, what we do is that we use the revenue. Okay, so this is a contract. This is construction. We know how contract costing works. Okay, so if after doing the work, a professional will come and inspect the work. So they come and inspect the work and give you the portion of the work that is completed, which we call the work has been certified. Okay, so the portion of the work that has been completed. So if they are saying that 200, this one is in terms of output. So if they are saying that the portion of the work that has been completed is 200 million in terms of value, it means that you have completed the work because the contract price is 200 million. So they are now saying that, okay, the portion of the work that is completed is 80 million. The total portion of the work that should be completed is 200 million. That is the contract price. But they are saying that you have only done 80 million out of it. The question now is, what is the portion of the work that is completed? The total work is 200 million. You have done only 80. So what is the percentage of the work that you have done? It will be the portion that you have done over the total times 100, which we call the work certified. The question will give you the value of the work that has been certified by a professional valuer or something. Then the contract price will always be given to you. Then you multiply by 100. That will be the percentage that you'll be using for your calculation.
Okay, thank you, sir.
All right, yeah. All right. So let's pick some. I have a lot of things to say, especially for the revenue. I have a lot of things to say, but let's take it small. Okay. So let's take some. That one is too simple. Okay, let's take the 6. Let's take the question 6 at least, because the things that I have, they are not plenty. I have incremental costs after winning a contract and the sell and repurchase. Okay, those are the things that I have right now. So let's pick plenty questions on this one. So let's take the question 6 first.
On 1 January 2020, Barkisu Limited, Barkisu entered into a contract with a customer to construct a specialized building for consideration of 2 million Ghana cedis, plus a bonus of 0.4 million if the building is completed within 18 months. The estimated cost to construct the building is 1.5 million. If the customer terminates the contract, Barkisu can demand payment for the cost incurred to date plus a markup of 30%. However, on 1 January 2020, due to factors outside of its control, such as the weather and regulatory approval, Barkisu is not sure whether the bonus will be achieved. As at 31 December 2020, Barkisu has incurred a cost of 1 million Ghana cedis. They are still unsure as to whether the bonus target will be met. Therefore, Barkisu decided to measure progress towards completion based on the cost incurred. To date, but Criso has received 1 million from the customer. Recommend to the directors of Barcriso how this transaction should be accounted for in the financial statement for the year ended 31 December 2020 in accordance with relevant IFRS.
You can see that this question is very simple, isn't it? Gone are the days that CR question were very simple. This was a question that the November 2021 that I was writing for reporting. This was one of our questions. You can see that very simple. It was like for 5 marks or 6 marks. Very simple. Which method are they using? You can see that this is what? This is a construction contract. So performance will either be, revenue will either be what? Or performance will either be satisfied over time or at a point in time. But since they are saying that they are using cost method, then it means that the performance obligation will be satisfied at a point over time. Okay. What is the total contract price?
2 million.
Okay.
2 million.
What is the cost of completing the contract? What is the total cost?
1.5 million.
1.5 million.
Okay. What is the profit on the total contract?
0.5 million.
Okay. So right now, what is the total cost that they have incurred?
1 million.
They have incurred 1 million out of 1.5, isn't it?
Yes.
Okay. We know that if you incur all the 1.5, it means that you have completed the work, isn't it? Then you are going
Yes.
to be having a profit of what? 0.5. So it means that 1.5 is equal to the 0.5. Now you have incurred only what? 1 million. So you can decide to find your percentage of completion, which will be the cost incurred to date over the total cost. You have to incur a cost of 1.5. You have to incur a cost of 1 million. So what is the percentage of the work that is done? 1 over 1.5 times 100. Or you can also find the profit that you'll be sending to profit or loss, which will be 1 over 1.5 times 0.5. We take our time to do it one by one. So first of all, this particular transaction should be accounted for using what? IFRS what? 15, because they haven't mentioned the standard. So sometimes they will say recommend in reference to a relevant accounting standard. So you can state which of the standard they should use for what? That particular transaction. So you can say this particular transaction or Barikusu or Bariki or something have to account for this particular transaction in accordance with what? IFRS 15, revenue from contracts with customers. They have entered into a contract, and this particular contract is a construction contract, which means that performance obligation will be satisfied over time. So they have to measure their completion in respect of what the cost that is being incurred. So you first determine the cost of completion, which is very simple. You determine the percentage of completion, which will be 1.0 over 1.5 times 100. What are we getting?
66.7.
Okay. So you have 66.7%. Okay. So it means that for this particular year, the company, they have to recognize the revenue. So let's find a portion of the revenue. So the portion of the revenue, what you do now is that what? If you incur all the 1.5, then you are going to be recognizing the revenue of 2 million. But you have incurred only 1 million. So what portion of the revenue you are going to be recognizing? It will be 1 over 1.5 times the contract price of 2 million. So that will be the portion of the revenue that they will be recognizing for this year. That will be how much? I'm having 1.33 million.
Yes, correct.
Okay. You can also multiply the 2 million by the percentage of completion. You still get the 1.33 million. All right. What will be the cost of sales? What do you think will be the cost of sales for this year? What will be the cost that they are going to be what? they are going to be reporting as cost of sales relating to revenue will be 1.33. What will be the cost of sales? What do you think will be the cost of sales for them?
That's 1 million.
The cost of sales will be the 1 million, unless you are using a different one. The cost of sales will be 1 million. So the cost of sales will always be the cost that you have incurred to what? To date. Okay, so you see that we are going to be having a profit of what? There will be a profit of what? 1.0 divided by 1.5 times what? Times 0.5, because the total profit on the contract is this one. And that will give us 0.33. Okay, so the profit can also be calculated as the revenue that you are recognizing minus the what? The cost. That will give you 0.33. So they say you should recommend. The recommendation is that a company have to recognize a revenue of 1.33, which you can put it in a bracket, which is calculated as 1.3 or 66.7% of the 2 million. And they also have to recognize a cost of sales of what? Of 1 million, which is the cost incurred to date. And this will be giving them a profit of what? Of 0.33. Okay, the question now is, if you want to bill this particular customer, what will be the total amount that the company will be billing the customer? What will be the total amounts? At least this, what will be the total? Let's look at the bills. The customer billing. Okay. Okay. The cost that the company have incurred is what? Cost incurred up to date is what?
1 million.
1 million. Okay. So whatever be the case, you have to bill, I have to pay for the cost, because that is the cost that I've incurred. I'm doing the work for you. So that is the cost that I've incurred. You have to reimburse the cost. Plus the what? The profit margin that I'll be getting on the work that I've done. So that will be the billing. So you add a profit to it. So the profit is 0.33. So the billing will always be the revenue. Okay. The billing will always be the revenue. This is the amount that we have to receive from the customer. But how much was received from the question?
1 million.
Okay. So amounts received, or you can say cash. Amounts received or cash is 1 million. So what will be the balance now?
0.33 million.
Okay, this is what we call the contract assets. So the company have to recognize a contract asset of what? 0.33, which can be a current asset or a non-current what asset, depending on the what? On the construction period. But this one, let's see the period over here. I'm sure it's only 2 years. So it's 18 months. We have done what? 12 months already, remaining 6 months. So this can be shown as a non-current. This can be shown as a current what? Asset. So it means that the customer has paid only the cost. They are here to pay the profit elements. This is all about this question. So the recommendation is you do your calculation, then you tell them the figure that they should send to profit or loss, the figure that they should send to statement of financial position. That is the recommendation that they are talking about. Or sometimes, if you like, you can also put the extra there. The extra also, you are doing the recommendation. So the recommendation is just, don't say that they didn't ask you to calculate. So you just go there and be doing and be speaking English. You are giving figures in the question. So at least you are not giving the figures for anything. You are giving the figures to use the figures. So do your calculation. Then the answers that you have gotten, those are the figures that you'll be using to tell them how they should go about this figure, how they should go about this figure, and how they should go about this particular transaction. That is the recommendation that they are talking about. All right. The recommendation is not option that they are giving you that you should say, okay, they should go for this one, they should go for that one. No, they are giving you a transaction and they should recommend. Just tell them how they should go about a transaction, how they should go about it, what will be the entries, what figure are they sending to profit or loss, what figure are they sending to statement of financial position. That's what they are asking you to do. So this particular question is under the input method. Let's go. Okay, let's take the question 7. This is performance obligation at a point in time or something. Question 7.
Shell Limited, Marshall, is a manufacturing company that prepares financial statements in compliance with IFRS and has a reporting date to 31 December. During the year to 31 December 2020, Marshall entered into a contract with the customer to manufacture and sell some goods, said that the goods will be delivered. Control of the goods vests with the customer in 2 years. The contract has 2 payment options. The customer can pay 500,000 when the contract is signed, or 650,000 in 2 years when the customer gains control of the goods. Marshall's incremental borrowing rate is 10%. The customer paid 500,000 on 1 January 2020 when the contract was signed. Marshall intends to recognize a revenue on this contract in the financial statement required.
Okay, let me go down for you.
Yes,
Okay.
in accordance with IFRS 15 from revenue from contract with customers, explain with supporting calculations how Marshall should account for the above transaction for the years 2020 and 2021.
Okay. So first of all, you have to identify how the performance obligation will be satisfied. Okay. What is the condition? Is it at a point in time or at a point over time?
At the point in time.
Okay. So at a point in time means that you can only recognize revenue when you have what? You have transferred or you have delivered the goods to the customer. Last time on Monday, I said that you are going to be facing with 2 situations where you sell to the customer, control will be passed to the customer, but the customer will be asked to pay at a later date, maybe in 2 years' time or 3 years' time. In that particular case, we have an issue of financing issues there because the goods has been given to the customer today, but the customer will be paying at a future date. It means that you are going to be putting in place some issue of time value of money. So there will be a financing there. The customer can also make a deposit and the goods will be given to the customer at a later date. You haven't sold the goods to the customer, but the customer's money is with you. In that case, you will be treating that particular money as a loan. So there are so many situations that you'll be looking at it. One will be the control will be, the goods will be given to the customer today, but the customer will be asked to pay at a future date. That will be having issues of financing option. Another one is that the customer will pay and the goods will be delivered to the customer at a later date. The amount that you receive from the customer have to be treated as a loan. Okay, so that is the case that we have now. We are saying that the customer can pay 500,000 now when we have signed a contract, but the goods will not be given to him. But he can pay the 500,000 now and receive the goods in 2 years' time. Okay, or the customer will wait and pay in 2 years' time if he receives the goods. That one, you are not giving the goods to him today, that you say that he is going to be paying in 2 years' time. No, in 2 years' time, he will pay the 6.5 million and you give the 650,000 and you give the goods to him. So there is no issue with financing over here. Okay. You are going to be giving the goods to the customer in 2 years' time, and the customer is giving you 500,000 now. Is there any sell? Is there a sell?
No.
No. You are owing the customer how much? 500,000, isn't it?
Yes.
Okay. The standard says that you'll be using this 500,000 to finance or to carry out other operations, which will be giving revenue. So regard this particular 500,000 as a loan and charge interest on it. So at this particular date, what will happen is that the contract was signed on what? Okay, the customer paid on first January.
1st January 2020.
Okay. So what will happen is that you are going to be paying interest of 10% for the 2020 year, isn't it? So you calculate interest on the 500,000, treat the amount as a loan, question 7. So the advance payment will be treated as a loan. the advance payment from the customer will be treated as a loan. So each year you charge interest on it. So the interest will be 0.1 times 500,000. That will give you 50,000. So this will be sent to profit or loss as a finance cost because you'll be using the money that the customer has given to you to carry out other operations that will be giving you income. So you have to charge the interest on that particular amount to the income that it will be generating. So in the statement of financial position, you'll be showing a loan at 550,000. Why is it 550,000? Because you have charged interest of what, 50,000 on it, which you haven't paid yet. Okay, so you come to 2021. 2021, you will still charge the interest of 0.1 times 550,000. The interest will be charged on the what? On the this amount. It will be done as compounding because the customer will not be receiving the principal and the interest. So you'll be rolling over the interest and then the principal. So that will be 0.1. This is not, we don't do it like simple interest. No, you are not paying the simple interest. The assumption is that, okay, if the first interest is due, you pay the interest to the person and the person will keep owing the principal. So it will be only the principal that will be yielding the interest at the end of every year. But this one, you are charging interest of 50,000. The person did not come for the 50,000. So the 50,000 together with the 500,000 will still be there. So the two of them are going to be yielding interest, or they are going to yield interest at the end of the year. So you are going to be rolling over the interest and then the principal. So what you do now is this year, you're going to be having 55,000 as interest for profit or loss. Then if you come to statement of financial position, you'll be having the loan as 605,000. So you'll be having a loan as 605,000. Okay, so maybe in 2 years' time, what if you have given the goods to the customer? What if you have given the goods to the customer? What do you do? If you have given the goods to the customer in 2 years' time, what are you going to do?
You recognize revenue.
Okay, then what will be the amount for the revenue now? Is it going to be 500,000 or is going to be
No.
5,000?
It's going to be 605.
It is going to be what?
605.
605.
The revenue will be 605. That is nice. Okay, you can also recognize the revenue of the 500,000. Then you reverse the interest of what? 105,000. So you'll be adding the interest back to the profit. You are going to reverse it. Or you
Okay.
can just take all of them as the revenue. Okay. Because the interest that you are paying is just a notional interest. It's just a notional interest. So if after this one you have sent the goods to the customer, then you have now sold the goods at 500,000, or you can just take all the 605,000 as a revenue, because if you recognize the 500,000, you are going to be reversing the interest or the 105,000 of the loan to profit or loss, and they are all going to be having the same effect as income. So that is how you go about it. All right. Let's take another one. Let's take another one. I want to take a question where you calculate this one for. Okay, I want to look at the one that they will give you. They will not give you the percentage of work complete. They will ask you to do that one yourself. Okay, let's look at the question 10.
Details from DV's long-term contract. Which commenced on 1st April 20X7. Invoice from client for work done is 2,000, and cost incurred to date attributable to work completed is 1,500. Inventory purchased but not yet used 250. Progress payment received from client 900. Expected further cost to complete project 400, and total contract value is 3,000. DV uses the percentage of cost incurred to total cost to calculate attributable profit. Calculate the amount that DV should recognize in its statement of profit or loss and other comprehensive income for the year ended 30th April 20X7 for revenue, cost of sales. So can you calm down? Can you scroll it to the
Austin, can you say it?
yes, sir.
Okay.
Calculate the amount that DV should recognize in its statement of profit or loss and other comprehensive income for the year ended 30th April 20X7 for revenue, cost of sales, and attributable profits on this contract according to IFRS 15, revenue from contracts with customers.
Okay. So what is the method that they are using? Are they using output method or input method?
Input.
Okay, they are using input method. So the percentage of completion is cost incurred to total cost to calculate what profits. So let's now come here. What is the contract price? What is the contract price?
3,000.
Okay, that is very nice. So the contract price is what? Okay. So the total contract value is 3,000. Okay. What is the cost of the work done?
So 2,000.
Are you sure?
1,000.
The cost of the work
Invoice
done is
1,500.
1,500, isn't it? Okay.
Yeah.
Let's now come. What you do is, you ask yourself, if you see a question like this, what the things that you have to calculate is, ask yourself, what is the contract price? The contract price over there is 3,000. What is the total cost of the contract? So let's calculate the total cost of the contract. What is the total cost of the contract? That is very important. What is the total cost of the contract? What will be the total cost of the contract? The first cost will be the 1,500, isn't it? Okay. The inventory purchase, where are we going to use it? We are going to be using it on the contract, isn't it? So the cost of the contract, the cost that we are going to be incurring will be 1,500, which we have already incurred, plus the revenue, plus the inventory. Then what is the cost that we have to incur to complete the project? What is the further cost that we have to incur?
400.
400.
400.
Okay, so the total cost of completing this particular contract will be the cost that you have incurred already, plus the expected cost. Maybe you can also buy an asset that you will not be what? You will not be using the asset. But since the asset will be used on the contract, we take that particular cost of buying the asset as also part of the cost to complete the what? The contract. So you ask yourself, what is the total cost of completing the contract? You will take the cost incurred to date. Okay. So you are doing something for me and you have incurred 2,000. You are saying that you are going to incur additional cost of 1,500 to complete the work. It means that the total cost of the contract will be 3,500. That is the meaning. So you have the 1,500. Then you have the inventory. The inventory will be used on the what? On the contract, unless only part of the inventory will be used. Sometimes the question can say that 100 of the inventory will be used on the contract and the 150 will be used elsewhere. Or the question can also say that 100 will be used, but the 150 will not have any other use. It means that you just take all the 250 as the cost that you are going to be spending on the contract. So we have 250 and we have the expected cost, further cost to complete the contract. That will be 400. What is the total cost now? What is the total cost?
2,150.
Okay, that will be
2,150.
Okay, 2,150. All right. What will happen is that the question is asking us to find the revenue and also the profits. Sometimes the question can ask you to find a profit straightforward. For you to find a profit straightforward, you just ask yourself, what's the total profit that you'll be getting on a contract? It will be the 3,000 minus the total cost of 21,150. That will be 850. Okay. What is the portion of the profit that I will be recognizing now? I've incurred a cost of 1,500. So I'll just do 1,500 divided by 2,150 multiplied by the profits. But the question is asking us to calculate the revenue and also calculate the cost of sales. So the revenue will be calculated as the cost incurred to date, which is calculated as a percentage of completion multiplied by the contract price, which is 3,000. So the percentage of completion is this one. They are using input method. So that will be the revenue. How much are we getting?
$2,093.
Okay. What will be the cost of sales? The cost of sales will always be the cost incurred to date, okay, which can also be calculated as 1,500 divided by 2,150 multiplied by the total cost. You still get that particular value. So you just ask yourself, what will be the profit elements? What will be the profit elements? So the profit, how do you calculate the profit? You can just find a difference between your revenue and that one. So 2,993 minus 1,500, or that will be 1,500 divided by 2,150 multiplied by the total profit from the contract. What are you getting?
$593.
593.
93.
Okay. Okay, 593. Okay. Let's now come here. If you want to bill the customer, what will be the invoice amounts? How much are you going to be billing the customer for the work that you have done?
I think 2,093.
It will be 2,000 and what? 93. That's nice.
93. Yeah.
Okay. So let's find the contract assets. So the contract assets, what we do is that we will have our cost incurred to date, which is the cost that we incur. So the billing amount is just the selling price of the contract that we have done. So that will be 1,500 plus the profits. That will be 593. Then you subtract the cash received from the customer. What is the cash received? How much are they saying is the cash received?
2,000.
900.
It's 900. That is the
900.
invoice given to the customer.
Yeah, 900.
Okay. You see, we have a contract asset and sometimes you can also have receivables. Okay. So I will explain the difference between the receivables and the contract assets. Okay. So that is 900. What will be the difference?
1193.
1193. Okay. All right. Let me tell you what the company can recognize this as receivables. Look at this. You see this amount. This is the amount that the company has given to the customer to pay. So they have given the customer 2,000 to pay, isn't it? The customer have paid only what? 900. So it means that the customer will be left with what? 1,100 to pay. The company can recognize this as receivables because this is just an amount that they are giving to the customer. It's not based on the selling price. They can ask the customer to pay just part of the price. The total price might be 3,000, which is relating to the work done. But they can ask the customer to pay maybe 2,000 out of it for now. Okay, so the remaining portion the customer will be paying, customer will be owing, that will be the contract assets. Because the total work that we have done plus the profit and the cost is 3,000. But we are asking the customer to pay what? 2,000. So if the customer, out of the 2,000, how much did the customer pay? Maybe they have paid 1,000, remaining 1,000. That particular 1,000 will be seen as the receivables. But the contract asset will be what? Will be 2,000 because the selling price is 3,000. We have asked you to pay 2,000, but you have paid only 1,000. It means that you are owing us 2,000 based on the what? On the selling price. But we are just asking you to pay 2,000 out of this one. But if you pay 1,000, they will be recognizing 1,000 as receivables. Okay, so you have to know the difference between them. What I also want to talk about right now is that they can ask you to do this one for 2 years. Okay, they can ask you to do this one for 2 years. Okay, let's assume that in the next year, the company have completed the what? The contract. They have completed the contract at the same price. Okay, if they have completed the contract, if they have completed the contract on the same price, what is going to happen now is this. So let's assume that the next year, which is 207. So they have completed the contract at the remaining price of the 650, which will be the 250 inventory plus the 400. Okay, so if they have completed the contract, it means that the total revenue will now be what? 3,000, isn't it? The total revenue related to the contract is 3,000. But out of this 3,000, how much was recognized in the previous year?
Is it 2093?
Yes. So we have recognized out of this 3,000, we have recognized only 2093 already. So it means that we only have to recognize the remaining portion in the previous year. So sometimes if you are finding the revenue on total basis, you will just be looking for the increase. It's just like a provision. The total revenue for the contract is 3,000. You have recognized 2,093 already. If you have completed a contract, the total revenue will be 3,000. But out of that 3,000, you have recognized 2,093 already. So what will be the remaining revenue? That will be the remaining revenue that you are going to recognize. Don't say that in the next year you are going to recognize a revenue of 3,000. It means that in total you are recognizing 5,093. So the previous year we only look for the increase. So the cost of sales, the total cost of sales should have been 2150. We have already recognized 1,500. We are only going to recognize 658 for this year. That is all. The total profit should have been 850. We have already recognized 593. What will be the difference? That will be the difference that we recognize for this year. So you have to pay attention to this one. They can give you 2 years. They can give you 2 years. You only find the difference. You only find the difference. You only find the difference. So this is for input method. Let's see whether we can get a question on the output method. The output method will always give you the value of the work completed. So the company completes the stage of completion of contract using the value of the work completed. So this one, if you come here, I will only demonstrate. The value of the work completed is 165, isn't it? It's 165, isn't it? Okay.
Yeah.
So the percentage of completion will be calculated as 165 over the total revenue. So we use, this is output method. So if you use the value of work completion, this is output method. So we use the value of work completed over the contract times the contract value. So for this one, the revenue will always be the value of the work that you have completed. If you want to recognize revenue, revenue will always be the value of the work that you have completed. So what is the portion of the cost that you have incurred on this particular one? This is how we calculate it. So the revenue will always be the value of the work certified or the value of the work completed. If you're using the input method, you only have to calculate the revenue. The cost of sales will always be the cost incurred. If you're using the output method, the revenue will always be the value of the work completed or the value of the work certified. How do we compute the cost now? This is how we calculate the cost. Okay, cost incurred to date is what? 170.
170.
We don't take the 170. Don't take the 170. Okay. Then what is the cost to complete?
Cost to 100.
Okay. Total cost is what?
Total cost were originally estimated to be 240.
Okay, but right now the total cost is what? We don't use the
270.
original again. We use the actual one that we have now, 270, isn't it?
270.
Okay. So the 270, we now do 165 over 300 times 270. That will give us the cost of sales. So we find the cost of sales relating to the revenue. The cost cannot be higher than the revenue, all things being equal, because this particular contract is going to give us profit. So we cannot do that. So what you do is you do your 165 divided by 300 times 270. What are we getting? I'm getting 148.5. So that will be the cost of sales. Okay. You can also find the cost of sales by using profits. So what will be the profit on the contract? The total cost that we are incurring on the contract is 270, and the contract price is what?
300.
So what will be the profit?
30.
Okay. If the profit is 30, but we haven't completed all the work. We haven't completed all the work. We have completed only 165. So what portion of the profit should be recognized on the work completed? 165 over 300 times 30.
300 times 30.
What are you getting?
$16.5.
16 what? 0.5.
0.5.
But you know that cost price plus selling price, cost price plus profit will give us the selling price, isn't it? Okay. Our selling price is 165. Our profit is 16.5. So what will be our cost price now? You just subtract and get your answer. What are you getting? You are getting 148.5, isn't it?
What? I adding or subtracting?
You subtract. This is the selling price. This is profit. We are looking for the cost price. So you get 148.5, isn't it? So you can also calculate the cost price by using the profit method. Okay. The question now is the amount that you'll be invoicing to the customer will be 165. So that is the selling price of the contract. How much did the person pay? The person have paid only 130. So you now have a contract asset of 35. All right. So this is about the construction contracts where you have to measure you use two methods, input method or output method. Very simple. Okay. Let's now pick another example before we talk about sell and repurchase. How do we go about it? Okay. So let's pick some other examples where issues about borrowing costs will come in. And
So, Lenos.
Yes, yeah.
Please, with the question 11, what will be the revenue to be recognized for the year?
The revenue will be 165.
Okay.
The revenue will
And
always
the
be the value of the
profit,
work completed.
and the profit will be 16.5.
Yes, please. Cost of sales will be 148.5.
Okay, sure.
Okay. And the contract asset will be the work completed minus the amount that you have received. That will be 35. Okay. So let's pick more complicated issues where I will talk about issues where borrowing costs and things will come in. Okay, let's look at question 14.
Okay, I get it now. Question 14.
Yeah.
Imoleco builds Imoleco builds apartment blocks, which normally takes 2 years to complete from the date of signing the contract. A performance obligation is certified at a point in time. The title and possession, and therefore control of the apartment blocks, pass to the customer upon completion of construction. The price which is payable on completion of each apartment block is 9.9 million Ghana cedis. Sorry, 9.55 million Ghana cedis. Alternatively, customers can pay 8.5 million Ghana cedis cash on the day that the contract is signed. The chief accountant has calculated that this presents an appropriate borrowing rate of 6% for Imoleco. Imoleco immediately recognizes 8.5 million Ghana cedis as revenue if customers pay when they sign the contract. Required. Discuss how Sandy Co. should have accounted for. Discuss how Sandy Co. should have accounted for the sale of the apartment blocks in accordance with IFRS 15.
Hey,
That's revenue from contract.
which one are you reading?
Question 14.
And you are
So I think it was, I think it was supposed to be
okay.
discuss how Imoleco should have accounted for.
The editing was not right. All right.
Yeah. So
Okay.
in accordance with IFRS 15, revenue from contracts with customers, and IAS 23, borrowing cost. And B, assuming the sale takes place immediately and the cash is received in 2 years' time, providing the accounting entries that will be required to record the contractual sale of an apartment block on 1st January 20x8 at a discounted amount over the 2-year construction period.
Okay, thank you. So
Okay.
how is performance obligation satisfied?
At a point in
time. So it means that the company can only recognize revenue after 2 years, isn't it? Because the contract is going to be taking 2 years. So they have to finish the construction and hand over the building to the company before they can recognize revenue. So if they say at a point in time, means that possession, title, and control will be passed to the person after the completion. So any amount that the person will be giving to you today will be treated as a loan. Okay. So they are saying that the price which is payable on completion of each apartment block is 9.5. Okay. Alternatively, customer can pay 8.5 million cash on the day that the contract is signed. The chief accountant has calculated that this represents an appropriate borrowing rate of 6% for Imoleco. Imoleco immediately recognize 8.5 million as revenue if the customers pay when they sign the contract. So how should they account for this particular transaction? What should be the accounting treatment? They say the customer has already paid for. They have paid the 8.5, and the company always recognize the revenue immediately when the customer pay.
So I think the amount that the customer paid should rather be treated as a loan.
Okay. So if the customer, so this one, they didn't say the customer have paid already, isn't it? They just say Imoleco immediately recognize 8.5 as revenue if customers pay when they sign the contract. So if the customer should pay the 8.5 when the contract is signed, then the 8.5 should be recognized as a loan, which will be treated as what? A loan taken to finance the construction of what? The blocks. So the interest that you'll be charging on it will be treated as a borrowing cost. So what you do is, you have your 8.5 as the initial amount of the building, then you'll be adding your interest to it. You'll be adding your interest to it. You'll be adding the interest for each year to that particular value as the borrowing cost for 2 years. So if the customer they pay the 8.5 down as the contract has been signed, then the 8.5 should be treated as a loan, which the interest on the loan will be capitalized
Treated
as
as finance cost.
Yes, as a finance cost for borrowing cost. That is why they have added the 23 to that one. It will be seen as the company has taken 8.5 loan to finance the construction of the assets. So the interest that you'll be charging on it will be treated as a borrowing cost, which will be added to the 8.5 at the end of every year. But if the customer has not paid the 8.5, then the company cannot recognize revenue until the building has been what? Transferred to the customer in 2 years' time. So the company can only recognize revenue of 9.55 in 2 years' time. So these are the things that you are going to be saying. If the contract is signed and the customer has paid the 8.5, what will be the accounting treatment for the 8.5? Okay. If the contract is signed and the customer have not paid the 8.5, what will be the entry? The company can only recognize revenue if the blocks or the apartments have been transferred to the customer. That will be in 2 years' time. Okay, that is the explanation to that one. Okay, B, assuming the sale takes place immediately and the cash is receivable in 2 years' time, provide accounting entries that will be required to record the contractual sale of an apartment block on 1st January 2x8 as the discounted amount over the 2-year construction work period. So they are saying that assuming that the sale has taken place immediately. So we have sold the apartment to the customer. Maybe we have completed it. It's just an assumption that the building is completed and the building has been sold to the customer immediately, but the customer is going to be paying in 2 years' time. How much are they going to be paying in 2 years' time?
9.55.
Okay. Assuming they have cash now, are they going to be paying the same 9.55 in 2 years' time?
No.
Assuming they have cash now to pay, are they going to pay the same 9.5 at the date that we are selling the item to them? That is the transaction date. Are they going to pay the 9.55?
No.
Okay, so it means that we are putting an issue of time value of money over there. Because if you have the cash and give it to me right now, I can use it to do something that will give me a return. But since you are going to be keeping my cash, it means that whatever I want to do with the cash right now, you should be able to give me that equivalent of that particular thing in the equivalent value of that particular thing in the future. If I need to buy 2 bags of cement with the money that you say you are going to pay in 2 years' time, I'll just tell you, I want to buy 2 bags of cement today. So in 2 years' time, just give me the amount that will help me to buy my 2 bags of cement. It means I'm looking at what inflation and those kind of things. So it means that there will be an issue of financing over here. So it means that there's a finance component over here. So what you do is that the company will recognize revenue at the present value of the amounts. How do we find the present value? You just find the present value, which is the future value over 1 plus r exponent n. The present value will be 9.55 divided by 1 plus 0.06 exponent 2, because this amount will be paid in 2 years' time. So the present value will be equal to 9.55 divided by 1.06 exponent 2. So that will be the revenue that the company will be recognizing today. And at the end of every year, they have to be increasing the what? The present value, because they are going to be receiving 9.55. So you have to be compounding it at the end of every year. So at the transaction date, the company will recognize what? Revenue at the present value of the 9.55, which will be discounted at the borrowing rate of 6%. At the end of the year, you increase the present value by 6%, and that will be treated as a finance income. So every year you calculate it for 2 years, then that will be the revenue that you are going to be recognizing. Okay, that is very simple. And what should I talk about again? I'm sure that the question on at a point in time and a point over time, I'm sure we have done a lot on that. And we should now look at another issues over here. I have some questions. Yes, Ina.
Please, how are we going to present it? I don't know. You didn't work it. I wanted to see how you are going to present it.
You want to see how I'm going to present it?
Yeah.
In the
Imagine
statement
there's
of,
a questionnaire.
okay, so I should show the journal entries.
Yeah.
Okay. So let's calculate the. Okay, so let's count to the first one there. We say that will be treated as what? As a loan, isn't it? So the company will be having a loan of 8.5. So this is happening at the beginning date. Okay, so you calculate your interest of, so you have a loan of this one and also have the cost of the asset to be 8.5. So what we'll do is that let's calculate the interest. The interest will be 0.06 times 8.5. What are we getting?
Zero point 0.51.
0.51
1
million. Okay, so at the date of this transaction, you'll be having the asset. So you have an asset, which is asset in completion, because a cost of, maybe you can say work in progress, that will be seen as 8.5 million. So you'll be having interest of 0.51. That is a borrowing cost. Okay, then at the end of the year, so what will happen is that you debit an asset, which is work in progress 8.5, you credit a loan of 8.5. So you'll be having a loan and then the assets. It's just like you are using the loan to buy the assets. Okay, so what will happen is that at the end of the year, you debit your assets, because with the interest 0.51, then you credit the loan 0.51. You are not paying the interest. So with this one, you are going to be using the idea of compound interest. But in actual sense, the loan that we use for borrowing costs, we assume that we pay the interest at the end of every year. So we charge the interest on only the principal. So this is the first year. The second year, what you do is you will still have your assets. Your assets will now be at what? 9.01. Am I correct? Your loan will be 9.01. Okay. Then you still have the interest. So the interest will now be calculated as 0.06 times 9.01. It will not be calculated on 8.5. The assumption is that we are not paying the interest. So the interest will be rolled over with the principal. So you calculate this. What are we getting?
0.54.
So 0.54. Okay. So you now have an asset. You debit your assets. So you debit your assets of, that will be 9.55. Is that correct?
Yes.
Okay. Then you now credit a loan of what? 9.55. Okay, it will be, you just credit them with the interest, so that if you add them, then it will be 0.54, 0. What? 0.54. Okay, so what will happen right now is that the asset will be, so at this date, you will now give the what? The asset back to them, isn't it? You give the asset back to the customer.
Yeah.
So what will happen is that you are going to be de-recognizing the asset from your books. So you will now credit the asset at 9.55. Then what will happen? You remove the assets, then you also remove the loan, isn't it? You remove the assets and also remove the loan. So the asset will be sold. The asset will be sold to the people. It will be transferred to them. And the loan too will be what? What do we do with the loan? What do we do with the loan? Okay, we credit the asset and debit the loan. Okay, we
So
debit
like
the
we are
loan.
paying the loan.
Yes, so you just remove them. You credit the asset and debit the loan. That will just cancel them. So if you credit the asset, it means that you are removing the asset. If you debit the loan, it means that you are removing all those two things from what? The statement of financial position. So you just remove them from the statement of financial position. Then you will now come and do your revenue now. You now recognize a sale now because you have sold the what? The asset. So you now recognize a sale. You will now recognize a sale on that particular transaction. That is all. You now recognize a sale on that particular transaction because the sale will now be 9.5 on that particular one. Okay. All right. Let's look at the second one. Okay. The second side is if the sale has taken place, then the goods will be sold at a certain price, but the person will be paying 9.55 in 2 years' time. So what we do is that you ask yourself, assuming the person has cash to pay, how much will the person pay? So you just find the present value of that particular amount, which will be 1 plus R exponent 2. So that will give you 9.55 divided by 1.06 exponent 2. Okay, so what are you getting?
$8.5.
It's 8.5 M.
Yes.
Okay, so you now, if the person should have cash now, you now debit receivables because the person will be owing you receiver 8.5 and you now recognize the revenue of that. At the end of every year, you will find finance income, which will be the interest income because the total amount that the person will be paying is 9.5, but you have reduced it, you have find the present value of it. So you find interest on the 8.5 and that interest will give you 0.51. So that will be taken to profit or loss as a finance income. The next year too, you will now calculate your finance income on the total value, which will be 9.01. You calculate the finance income. And at the end of the day, that will be, so you debit the receivables because the receivables at the end of the 2 years, it has to be, so debit receivables of 0.51, then you credit finance income or profit or loss. So finance income or profit or loss with 0.51. Okay. In year 2, you calculate interest, which will be the finance income on this amount. Then you still debit the receivables and credit the finance income. And the receivables will now be 9.55 at the end of the second year. And that will be the amount that you'll be receiving from the customer. That is it. Austin, are you okay?
Yes, sir. I'm okay.
Okay. Okay. So let me talk about sell and repurchase. Let me talk about sell and repurchase. Okay. So sometimes a company will enter into a transaction to sell an asset to they will sell an asset to a particular company, mostly a bank. Okay. They will sell the asset to the company, then they will now have they will say, oh, they are going to buy it back. Okay. What do you have to look at? What do you have to look at before you know that this is a sell? Okay. You are saying that you are selling your phone and you buy it back. You have sold the phone to me and I've given you money, but you haven't given the phone to me. That cannot be seen as a sell because control associated with the phone, the risks associated with the phone has not been passed on to me. The goods are still with you. So that cannot be seen as a sell. So the amount that I've given to you will also be treated as a loan. So sometimes a company will enter into an agreement to sell and repurchase back. Mostly you ask yourself, who are they selling to? If they are selling to a bank, you just assume that they are using the asset as a collateral security to take loan from the bank. So mostly we see that they are using the item to take a loan from a bank. So if the sale is to a bank, you just have to take the amount that the bank is giving to them as a loan. Okay, but there are certain things that you have to look at. When do we recognize revenue? When control associated with the what? With the asset has been passed on to what? To the customer. When a risk associated with the what? With the asset has been passed to the customer. Possession of the asset has also been passed on to the customer. So you have to use these ones to know whether the thing has actually what? It's actually a sell or it's not a sell. Most of the times they can be selling a maturing asset, but a maturing asset will not be a biological asset. Why do we say that it will not be a biological asset? You see that some people, they can have goats that someone will come and buy the goat and they will still keep the goat under the care of the original owner that they should take care of it. If the goat matured up to particular level, we count for it. For that particular one, the sell and repurchase that we are going to look at over right now does not apply to biological assets, because biological assets, someone can come and buy your sheep and leave it with you. That is okay. Since you have a lot of them over there, it should be with you. For that one there, that one is practically possible in real life. So the maturing asset should not be a biological asset. But if the sell and repurchase is a biological asset, we have a situation where you can buy and still leave the biological asset, maybe the goat or those things with the person. Okay, so for that particular one there, we don't have any problem with that. Okay. But if the item is not a biological asset, you have to ask yourself those questions that I have asked. So a sell and repurchase agreement is where an entity sells an asset but retains a right to repurchase the asset at some point in time. Sell and repurchase agreements are common in property development and maturing inventories, such as whiskey or cheese. The asset has been legally sold, but there is either a commitment or an option to repurchase the asset at a later date. The point in time at which to recognize revenue depends whether the control has transferred to the customer. That is very simple. The asset that you are selling that you want to buy it back, is it with the person that you are selling it to? If it is with the person, who bears the insurance and those costs? If it's that particular person, it means that you have sold the asset, so you can recognize revenue. Okay, so you have to ask yourself those questions. Factors to consider when determining who has control of the assets. Has the entity transferred all of risks and benefits of the assets and therefore control? Can the entity still use the asset? Does the entity bear costs associated with the asset? These are the questions that you have to ask yourself. If you are saying that you are going to sell the asset, it means that whatever is going to happen, whatever will be happening to the asset, I will be the one to take care of it, because you have sold it and you have nothing to do with that particular asset again. Was the asset sold at a price different to market value? So what is the market value of the asset? And at what price are you selling the assets? If you are selling the assets at a value lower than the market value, that cannot be seen as a sell. That cannot be seen as a sell. Or if you're also selling at a price higher than that one, that can also be seen as maybe something else. So if the asset is sold at a market price to a particular person, you can say that, okay, you have actually sold the thing, because that particular one is that is the actual price that you have sold it, so you have sold the assets. But if it is below that part, the market value, it is assumed that you are just using the asset to take loan. All right. Is the entity obliged to repurchase the assets? Do you actually have the right? Or is it compulsory for you to purchase the asset back? Those are the questions that you have to. If the entity has the option to repurchase the assets, are they likely to exercise this option? Is a sale to a bank or a financing company is repurchased at a fixed price or market value? So this one, you just have to use the criteria for recognizing revenue. Control, risks, possession, title, and everything associated with the asset has been passed on to the customer. But another one is, if the sale is to a bank, automatically we recognize the amount taken from the bank as a loan. The company will still be keeping the assets. We don't recognize revenue. The amount received will be recognized as a loan, which the company will be charging interest on. So the sale and repurchase is very important, that you have to pay attention to that. Let me see whether I can have a question on that. Then I will talk about something that we call incremental cost. Okay, let's look at question 5. Okay. Austin, are you there? Question 5.
Question. Second question.
Yeah, question 5. Austin.
Okay, question 5. So can you bring it up?
Okay. Austin, can you see it?
Yeah, I can see you are now at question 11.
Hey.
Laidlaw prepares financial statement to 30 September each year. On 1 October 20x2, Laidlaw sold some maturing inventory, which had a cost of 4.5 million to a bank for its fair value of 5 million. Under the terms of the sale agreement, Laidlaw has the option to repurchase the inventory after a period of 10 years at a price of 7.4 million. At this date, the fair value of the inventory is expected to be 11 million. Annual rate of interest of 4%. Required with reference to the relevant IFRS, show how the above transaction should be accounted for in the financial statement of Laidlaw for the year ended 30 September 20x3.
They are selling to a bank, isn't it?
Yes.
So what do we do? This is not a sell, isn't it? They are going to be treating the amount as what? As a loan. How much are they receiving from the
As a
bank?
loan.
How much are they receiving from the bank? The cost of the asset is 4.5, and it has been sold at 5 million. Okay. So if the company has already recognized a revenue of 5 million cost of sales of this one, you are going to be reversing it. So the company will still recognize the inventory in their books at 4.5, and the 5 million will be recognized as a loan.
5 million.
The 5 million will be recognized as a loan, which they will be charging interest of what? 4% on it. So from 1st October to 30th September, the company will be charging interest of 4%. They are going to be having a finance cost of 0.04 times the 5 million. Okay, and in their statement of financial position, they will be having a loan or a liability of 1.04 times 5 million. That is very simple. All right. I want to talk about the last thing, then we just end it over here for the revenue. You see, sometimes a company may be negotiating a contract with a customer. So you cannot just stand up and go and win the contract. No. Negotiation and those things will be there, and you are going to be incurring some. You will incur certain costs before the contract will even be won. So maybe the company is in Accra and the customer is in Kumasi. So every day you have to take you have to go to Kumasi to have the negotiation with the clients. So you'll be incurring transportation costs and those kind of things. Okay. After the contract is being won, the company can also pay those who worked on the contract for them to get a contract. They can pay them bonus. Okay, you can see that the transportation cost was incurred before the contract was signed or the contract has been won. But the bonus has been paid after the contract has been won. There are two types of costs over here. One will be incurred before the contract has been won, and one will be incurred after the contract has been won. What does the standard say about these two costs? One of them will be called incremental cost, and one of them will be called maybe a past cost or a sunk cost, a cost that will eventually or that will be incurred even if the contract has been won or the contract has been signed. Because the transportation, even if the people you have not won the contract, you will surely go to Kumasi, or you have spent the transportation to Kumasi to have a negotiation with the clients. So that particular transportation cost, whether you win the contract or not, you still incur that particular cost. So the cost that will be incurred before the contract will be awarded, those costs are expensed. They are treated as a sunk cost, past cost that will be incurred even if the contract is awarded or not. So the question will say that, okay, the company has spent this amount of money preparing the proposal and those kind of, or delivering the contract to the people before the contract will be awarded. That particular cost must be expensed because they are costs that has been incurred before the contract has been awarded. If the contract is not awarded, they will still be incurred. So those costs, we cannot avoid them. It's a cost that are not relevant to the contract. They are just treated like maybe a research cost or a sunk cost. But after the contract has been awarded, bonus has been paid to those who are involved in the negotiation of the contract. You can see that the bonus is coming with the contract. If the contract has not been awarded, bonus will not be paid. So the bonus will be seen as an incremental cost. How do we go about that particular incremental cost? That cost is directly attributable to the contract. So the contract is 5 years. The bonus payment will be capitalized as a contract asset, and it will also be what? Expense over 5 years. If the contract is going to be based on unit basis, the cost will also be apportioned based on the what? The delivery of the units. That's how we do with the cost associated with the contracts. We have costs that you are going to incur before the contract will be won. Those costs will be expensed. By incremental cost, what is the cost that has been incurred after the contract has been? This will always be commission. This will always be bonuses paid to what? To the people who have won the contract and other issues. Okay. This is one of the questions that are brought in the exam for both CR, the mock, the pre-mock. This is one of the questions that came in the mock for both CR and the FR. For the purpose of something, I'm going to solve only the one that is under CR, under ethics. There's issue with, I should analyze what the manager is saying is correct or something. That's what I'm going to be solving. I won't solve the one that came in financial reporting for a reason. Okay, so this is also this is a pre-mock question for corporate reporting. This particular one is at a point over time. So at a point over time, if the contract has been modified, sometimes the person will tell you that, okay, I want you to construct 3-story building. Maybe you have started and the person is saying that, okay, add another floor so that it will be 4-story building. It means that it is the same work and the contract has been modified. So you also have to re-estimate your total cost and the revenue that you'll be recognizing. So this has to do with a re-estimation of what your total cost, and that is the question over here. Question 17 is about re-estimation of the total cost. The company has recognized a revenue based on the original one, but now the contract has been modified. You have to now re-estimate your cost of completion or the revenue that you should recognize. So that's only about this one. You have to re-estimate it. I won't go with this. And this one too. Okay, let me solve the question 18. Okay, let me solve question 18. So that is about the incremental one. All right. Who is taking it for us? This might be the
Question
last.
Question 18.
Yes, please.
On 1st November 2021, Excitement Limited, that's EL, entered into a contract with Pride Limited to manufacture and sell 100 units of a specialized machine at a total consideration of $300 million. The machine will be received in lots of 20 units at the end of each quarter. PL has paid 10% non-refundable consideration in advance, while the remaining consideration will be paid in 5 equal installments, only after delivery of each lot and not before. The sale term of EL worked hard and spent 1,600 hours, costing $4 million for preparing proposal for the contract. The team was also rewarded with a bonus of $6 million upon obtaining the contract. Up to year ended 31st December 2021, EL had manufactured 15 units of the machine to be delivered on 31st January 2022. EL's CFO, a chartered accountant, has suggested that revenue for 15 units should be recognized in 2021, as the machines are of specialized nature. And please, can you hear me?
Yes, please.
ELCFO, a chartered accountant, has suggested that revenue for 15 units should be recognized in 2021, as the machines are of specialized nature and have no alternate use for EL. Further, the sales team cost of $100 million should be taken to statement of profit or loss in 2021, as this has been fully recovered through 10% advance received from PL. Require. Analyze the treatment suggested by the CFO in respect of the above contract. B. Briefly explain how CFO may be in breach of the fundamental principle of Code of Ethics for Chartered Accountants and how he should respond.
All right. Okay. So what is happening here right now? The people, they have entered into a contract to supply what? To manufacture and sell what? 100 units of what? Specialized machine at a total consideration of 300 million. So you can see that this is a construction contract, isn't it? Okay, so the revenue
Yeah.
can be, the company can, so this can be seen as performance obligation satisfied over what? Over time. Since it's a construction, the default is that the performance obligation should be satisfied over time, unless the question says that it is the policy of the company to what? To recognize revenue at a point in time. Okay, so this one, they can decide to recognize the revenue at a point in time or at a point over time. So you have to first tell the people that this one, the CFO is saying that the revenue for the 15 units should be recognized in 2021 as the machines are of specialized nature and have no alternative use. The meaning is that since we are done with the manufacturing, we can't use the machine ourselves. It will surely be delivered to the people. So it means that we have manufactured 15 out of it already, and that will be delivered. So what is the revenue for the 15 manufactured? We can recognize it. It means that we have done 15 of it. So since we have done that part of the work, we can recognize revenue relating to that work. So that will be revenue recognized at a point over time. So the machine will be delivered in what, 20 lots at the end of each quarter. Okay, so if you are done, you will deliver. If you are done, you will deliver, unless there is a fault with it. But since we are done 15 out of the 20, this is a machine that is specialized in nature. We can't use it for anything. So since we are done with that one, what is the cost that we have incurred? And what should be the revenue? So that will be a point over time. So we can recognize revenue on this particular 15 because the machines are specialized in nature. We can't use it. We can't sell it to anybody. It will surely be delivered. So we recognize revenue on the 15. What will be the revenue that will be recognized on the 15? What will be the revenue that will be recognized on the 15? Okay, so revenue to be recognized will be 15 over 100. Am I correct? Times 3,000 million.
15 over 100 times 300.
Okay. Is it 300 or 3,000?
$300 million.
Okay, that will be 300 million. Okay, they haven't given us the cost, but the cost will not be an issue. The cost will not be an issue. Okay. So let's calculate this. That will be what? How much are we getting as a revenue?
45 million.
It is what?
45 million.
Okay, 45 million. So the revenue should be 45 million. They say the person have paid a certain amount as what? So the person has paid a no
10%
no.
non-refundable consumer
Okay, so let's find
consideration.
let's find the advance. How much are they paying as advance payments? That will be 0.1 times 300. That will be 30.
30 million.
Okay. So the amount that we should be receiving from them should be what? 45 million based on what? If the 15 should be delivered, it means that we will be receiving 45 from the people, isn't it? Okay.
Yeah.
The 45, but they have paid 30 right now. So what will happen is that if we deliver, we'll be receiving what? A net amount of 15, isn't it?
Yes.
Okay, so
Yeah.
you can show the 15 as receivables. Okay, so which will net the 45 against 30. That will be receivables as 15, but the revenue will be 45. They haven't given us the cost. So yeah, Nick.
Yeah, but we recognize revenue when control and all these things are passed. But here they've not done that. So why are we?
At a point over time. So at a point over time, it means that as soon as we have done with part of the completion, you recognize revenue. The machines are specialized in nature, which means that you are going to be delivering it 20. It will be done 20. Every delivery will be 20. Every delivery will be 20. But we have produced 15 before the year has ended. Okay. But these particular machines are specialized in nature. It means that we are not going to sell it to anybody and we are not going to use it for ourselves. So it means that after we are done with the production of the additional 15, we will surely deliver to the people. So since we have manufactured 15 out of it, we have incurred costs on that. The 20 that will be delivering also, the revenue will be recognized on each of them one by one. So we can recognize revenue on each of them one by one. So what will be the revenue that we should recognize on the 15? Because this will surely be delivered in the next year. So it's because of how the machine is specialized. It's a machine that is special. We cannot use it for anything. We cannot use it for anything. So we use the point over time. Although we cannot transfer ownership to the person, but since it's a construction contract, we recognize the revenue at a point over time. So it will be based on the completion. We have done 15 out of it. We have completed 15. Let's recognize revenue based on what? The portion that is completed.
Okay.
Okay. So that is that for, so that will be 15 million as the net receivables. Okay. Let's now come to, so the suggestions that that particular person has made as a result of the machines being specialized in nature. Since the revenue will be recognized based on completion, the level of completion. We have completed 15. Recognize the revenue on the 15. Okay. The sales team worked hard and spent what? 1,600 hours, costing 4 million for preparing proposal for the contracts. The proposal, is it going to be a cost before the contract will be awarded, or it will be a cost after the contract will be awarded?
Before.
Okay, so what will happen to the 4 million?
To be expense.
It will be expense, because if without winning the contract, we can still incur this particular cost. So the 4 million have to be expense what? Straightforward. It has to be expense. Don't say that you are going to what? You are going to amortize it over 16 hours. No. It is a cost that is incurred before the contract has been awarded. So you take it to profit or loss straightforward. The team has also rewarded with a bonus of 6 million upon obtaining the contract. Up to year end, 31 December, EL had manufactured 15 units of the machine to be delivered on 31 January 2022. So the question now is, the 6 million is a cost that has been what? Incurred after winning the contract, isn't it?
Yeah.
So this is an incremental cost. This is an incremental cost which should be capitalized as a contract asset. But how do we do it? It will be amortized over the contract life, or in a manner in which the goods will be delivered. So you see that we are delivering 2020 every quarter. We are delivering 2020. So right now we are recognizing a revenue for 15 units. So we just do the 15 over 100 times 15 over 100 times 6 million. So if the delivery is going to be equal, if it is 2020, then we do 20 over 100 times 15. It means that we are recognizing revenue on the 20. So what portion of the 6 million will be for the 20? But if you are going to be using months, they are not going to tell you how the delivery will be done. So they will just tell you that, okay, the person has performed only 3 months of the contract. Then it means that you also have to apportion the 6 million on time basis. But this one, we are using units. We are using unit to recognize the revenue. So the 6 million will also be amortized on the unit basis. We are recognizing 15 for revenue. So 15 over 100 times 6 million have to be recognized as an expense. The remaining one will be shown as a contract asset. Okay, so let's see what the the accountant is suggesting what the accountant is suggesting based on the 6 million. Okay. Okay, I have no alternative use for EL. Further, the sale team cost of this should be taken to statement of profit or loss in 2021, as this has been fully recovered through what 10% advance payment from PL. No. The 4 million out of it should be sent to profit or loss, and 6 million should be what? Should be capitalized as a contract asset, which will be amortized based on the what? On the units that has been delivered. So that's how they go about it. So that is the treatment. The suggestion for recognition of the revenue, which is based on completion, is correct. But the suggestion for treatment of the sales team cost is not correct. For only 4 million should go to profit or loss, and the 6 million should be capitalized, which we call the incremental cost. So we don't know what the institute is now doing, because if we do provisions 37, there is no issues where you have to be reassessing. Sometimes the estimate for decommissioning costs might change, but there is no way they have examined that before. Last sitting, they have examined where you have to reassess the decommissioning costs. So we don't know where the incremental costs and these ones will also be coming. And impairment, you see where we have corporate assets. You have to pay attention to that one too very well. So they will try to examine more complicated things in CR. So this will purely be a CR question. And explain how the CFO may be in breach of the fundamental principles of Code of Ethics for Chartered Accountant, and how he should respond to this. So this one, you just take the Code of Ethics one by one and see the ones that his suggestion is going to have a problem with that one. The first one, I can say that the first one is a professional competence and due care. Can you see that the first principle that will be having a problem over here is professional competence and what? Due care. You will see that the CFO is not having the knowledge needed for what? Dealing with this particular transaction. He's not updated with issues. He lacks the understanding or the critical understanding of the principles of IFRS 15. So he doesn't have the expertise or the knowledge to give an advice or to give verdict on this particular transaction. That is the first one. The second one will also be an issue of integrity. Integrity has to do with the accountant being honest and straightforward. What is he trying to say? Look at the treatment of the bonus. The bonus, if you are treating the bonus like that, it means that you are giving a false information about the bonus. You are saying that the bonus is just an amount that is paid for a transaction that has already happened, or for performance obligation that has already happened at once, and it will not be repeated again, or it's something that is not going to happen on continuous basis, or a contract that is being performed at once, and that is the end of it. So you are trying to give a false information about the presentation of the 6 million, and also saying that the 10 million is fully recovered through the 10% is also, that one is also a false information, because that is not right. That is not right. So if the CFO is now asking the accountant should go by this one, it means that the accountant will be coming out with a false information, which is not going to be happening. Another one, someone can also talk about objectivity. Is where the accountant should exercise professional judgment, and it should not allow any individual interest and those kind of things. Instead of him to go and look for the correct treatment of this one, he's trying to feel that he's a CFO and he knows everything. So he doesn't want to say that, okay, I don't know about this. I don't know about this. So go and go and ask somebody or go and read about it. But because of he doesn't want people to see him as someone who doesn't know the thing because of personal interest and those one. He's now trying to give a false information just to support the position that he's the CFO. And since you are doing this, professional behavior will also be having a problem because as a chartered accountant, you are expected to be to be on top of issues relating to accounting. You should be abreast with current standards and current requirements of the profession. He's just sitting there, he doesn't know anything. And someone will say, how can a chartered accountant give this particular advice? That particular thing that they are saying is something that is speaking bad about the profession. So the professional behavior is saying that professional accountants should not engage in activities that would discredit you don't know the thing and you are giving the advice. What are you saying about the profession? How will people think about you? How should he act? The best thing is that you can see purely that he doesn't have knowledge about the thing. You can call friends that, okay, this is the situation that you have, and you don't know how to go about it, and they should help you. Or you can tell whoever he's giving advice to that, okay, he will get back to him, and let's search for it, or we should seek the advice of an expert who will come and do this thing for us. So you just have to look at the best way of going about this particular issue. You can seek the view of experts on this particular transaction. He can also ask a colleague, or he can even do research about it on this particular issue. All right, so seniors, basically that is about this particular question where we have incremental cost. You just have to take note of it. The cost, especially commission, bonuses paid after winning the contract, they will be amortized, they will be capitalized as a contract asset and amortized on the basis of fulfilling the contract. But any cost that is being incurred before the contract is being awarded will be expensed because they are costs that will actually be incurred if the contract has been awarded or not. They will still be incurred. All right, so basically, I'm sure this is the end of it. And we are done with revenue, and we are done with practically all the standards. We have done well. I'm thinking about doing joint venture, but I will do that one during revision. So corporate reporting people, you should be seeing question on IS 31 and IFRS 11, joint arrangement and interest in joint venture. So you see question on it, and you should prepare for that. All right, so seniors.
Senior Linus.
Yes, please.
Senior, please, have we done a financial instrument?
No, we are done those ones during the dawn class.
Okay, so we can do it here.
Yeah. So I've just shared the notes on the page. So you just go to the YouTube and watch it because whatever I've said over there is the same thing I'm coming to say over here.
Okay.
So
okay,
any special leases and those ones, you just go there and watch them. Yeah, the standards are plenty. We cannot do all. It means for corporate reporting, we still have standards. We still have some minor standards over there. But let's see how we go about it. So Monday will be for only corporate reporting. FR people, you people are not expected to enter. So Monday we look at disposal situations, consolidation. Wednesday we try to look at complex groups. Then Saturday we try to look at cash flow, consolidated cash flow. Then we write a mock on Tuesday. Then maybe Thursday we start with the intervention. But whatever be the case, the intervention, the flyer will be out, and you just help us to circulate them. All right. So seniors, if we don't have any question, any concern, then I want to leave us here so that we can all Venice.
Sir.
Yes, Venice.
Yes, but we are meeting tomorrow, 3 p.m., right?
Yes, please.
Okay.
Answer reporting.
Yeah.
All right.
Thank you.